Thank you. Well, this is the special called investment committee meeting of the Kentucky Retirement System Investment Committee, as I said, on September 6th, and I will call it officially to order. We have do we have a legal statement, please?
Yes, sir. For the record, I want to note that this is a special called meeting of the Investment Committee of the Kentucky Retirement Systems. This meeting is being broadcast via video teleconference pursuant to Kentucky Revised Statute Section 61.826 and may be viewed by the public at the Kentucky Public Pensions Authority offices located at 1260 Louisville Road, Frankfort, Kentucky. It is also being broadcast to the public via Facebook. I ask if you are speaking and are not appearing by video, please identify yourself before talking. In the event this meeting becomes disconnected from Facebook, we will attempt to reestablish a connection. If a connection cannot be reestablished within 30 minutes, the meeting will be adjourned and rescheduled to another date.
Thank you. Could we have a roll call, Sherry?
Yes, sir. Mr. Lane,
Here.
Mr. Atkins,
Here.
Ms. Bova,
Here.
and Ms. Thompson.
Here.
Thank you.
Pam, it looks like you're back in Louisville as well.
I am after 2.5 weeks in Utah.
Yeah, we traded guests out there. We
I
had
know.
we
They
had
went from your
guests that
house to my house. Yeah.
started in at our house, and then we shipped them off to Pam up in Utah. So they had, I mean, they had the most charming host they could ever have, of course. That said, do we have a public comment?
No, sir, no public comment today.
Thank you very much. And so we will proceed to our single item, and I'll make a little editorial. I think maybe I came in on the end of Steve stealing my thunder, but this is I would call this a very interesting investment, and one that we have had success with the manager and success with the structure of this. And we have an opportunity to put more money to work, which is kind of difficult in the real assets category, as you've experienced the last few years. But this one definitely is a proven and attractive and a good fit for that category. So while it's not here, I think maybe some of you have read the Wilshire comments. Wilshire actually uses SVP as in one of their funds. So they were not just writing about, they use these structures in their funds, and they give them a 4 rating out of 5. I don't know what it takes to get a 5. It's kind of like, what does it take to get an 800 credit rating? But no one knows, because no one's got one. But maybe sure some managers have a 5, but a 4 is awfully good in their world. So with that said, I will turn it over to Steve and let him go into the weeds a little bit on this.
Thank you, Pruitt. Appreciate it.
As well.
Yeah, and thank you for everyone's time, especially on short notice. We appreciate the opportunity to present this. And as Pruitt mentioned, we're excited to present this recommendation for a compelling real return investment with Strategic Value Partners. SVP has successfully managed assets for KRS for almost a decade and currently manages over $150 million across the systems. As Anthony and maybe Wilshire will discuss, this opportunity is unique both because of the asset as well as the structure. For several years, the KRS and SPRS portfolios maintained a structural underweight to the real return asset class. And that was really the result of lack of compelling investment opportunities, especially on a risk return basis compared to other asset classes. As we know, the market has shifted over the last 2 years, and the opportunity set has really expanded with the current relative risk return for a number of real return investments becoming much more attractive on a relative basis. Over the past several quarters, staff has been active sourcing and reviewing real return investment opportunities with compelling economics that really are complementary to existing investments in the portfolios. Most recently, as you're aware, we've added investments in sports franchises, farmland, barge leasing, and a closed-end fund strategy. Currently including the public market proxy allocations, but not accounting for capital that we've committed but has not yet been called by managers. The KRS and SPRS portfolios are just about at their respective targets for real return allocations or modestly below, anywhere from 100 to 140 basis points below the revised target for real return. We anticipate the first capital from our farmland manager will be called this quarter, with other managers likely to continue to call capital over the coming quarters based on their visible investment pipelines. And we anticipate that these additional capital calls should increase allocations by 150 basis points to 200 basis points across portfolios. As this capital is deployed, we will wind down the existing proxy program to fund these new investments. As we've previously discussed, and when we presented all of those different managers or mandates, the real return landscape is a very broad and encompasses a number of public and private asset classes. What we focus on, the characteristics we consider when evaluating opportunities, really include investments with favorable standalone risk-adjusted returns, return streams that are not highly correlated to traditional assets, investments that provide sensitivity and meaningful diversification during periods of inflation. Additionally, they provide yield and current income, which is often from contractual cash flow streams. So that's what we focus on when we look for unique opportunities. Again, it's a very broad landscape, and there's different opinions what falls into real return. I think we've considered some different asset classes that other systems or other investors might classify in different ways. So we really look for kind of that unique, as demonstrated by the current portfolio, kind of unique investment opportunities that are differentiated from the rest of the portfolio. So with that, I'll turn it over to Anthony, and also just wanted to note, as Pruitt did, that Wilshire is on the line to answer questions as well.
Yeah, thanks, Steve. Yeah, like you mentioned, we have worked with SAP for quite a while now. This is from their fourth fund, which was raised in 2018, or we committed in 2018. This investment was done already in 2017, while the fund was still being raised. And what they're doing now is a continuation for a toll road asset. Strategic value partners, ideally, their strategy is to gain control of good companies with bad capital structures by directly sourcing their debt and then working to restructure things. This was kind of a classic case of that. It was owned by a Spanish infrastructure company, and that had over-levered it. And the projections were a little optimistic as well to get that leverage. I think there's also an interest rate swap involved that kind of may have been the straw that broke the back. But the combination of all those things caused us to go into distress. Strategic value partners was able to source a lot of the debt to be able to get control of it, as a lot of European banks, I think, were the owners of that debt at the time. And so once they were able to get control and take the asset out of bankruptcy, they were able to change management, remediate some actual construction issues that were happening, and they got the previous contractors to actually pay for it with the settlement. Then they also repaired some of the relationships they had with the government, obviously who is regulating this, and that the concession is managed with. So the Texas Department of Transportation is obviously a key constituent. So by getting some folks with those kind of backgrounds and experience to be involved, they've kind of remedied that, and now it's at a good base. The road quality has been rated well. They have just completed some of the capital expenditures for that, so there isn't a large need for that in the near term. And so the reason for the continuation vehicle, because obviously there's some question on why don't they just sell it and realize a pretty good return, which is going to be over 2x net at this point. They just believe that there's still more value to be created. And so that's part of why they're rolling $100 million of their own money into this, mainly the proceeds from the initial investment in 2017, as well as a little bit of additional investment. And then they've also, their two anchor investors who are speaking for several $100 million of this as well. One odd thing about these continuation vehicle structures is sometimes they're done at a slight discount. I think that's partially so that the secondary managers can, it can price, or it pencils out for them better. So it would the price right now would be a little bit 1 or 2%, maybe a couple percent discount to the current the asset value is at least that's the headline price. So it would crystallize the investment in Fund 4 for us, and then we're looking to do an additional investment in this toll road. So as you probably saw in the memo, the growth opportunity they have is for development. There's a connector road that if they're able to pass a bill in the legislature, which has already actually passed one of the houses before, but didn't make it all the way through last time, then the concession goes through, which the local officials are interested in. Actually, one of the New Braunfels, I think, representatives is the one who proposed the bill and got it through one of the houses. Then ideally the concession could increase for another 20 years, which would also add value, and additional development along this very fast growing area would continue to add value to the road. Even if that's not there, though, I think that's the case that Wilshire and that's had. The road has continued to grow with the growth of Texas, which is again, likely to continue happening, not super correlated to public equity or fixed income markets. Obviously, it's a real asset with tangible value that's going to continue to be there, and yeah, there's a good balance of traffic, both just regular people. It's a little under half. Like I think it's about 60-40 trucks versus regular vehicles who are trying to gain the convenience of not being on I-35, because with all the growth, it's kind of outpaced the capacity of that road, especially for the folks who need to move cargo through that very fast-growing corridor. This toll road provides a much more consistent experience. So that is worth it a lot. I mean, the traffic, sometimes obviously the I-35 may be congested or not, but if you can't really predict that, the predictability is actually a lot of the value that's there for folks. So through growing awareness and then raising tolls, which has grown earnings a lot, but still but traffic demand has still continued to grow as well. I think that shows the value of this asset, and the ideally that it will continue going forward. So that's what we think is interesting as well, along with SVP, and that's why we're proposing this investment. We're happy to take any questions if you guys have some. But yeah.
So
Yeah.
is this a fully built and established road, or is it still in the process of being developed?
It's a great question. It is established road. It opened, I think, in 2012. So that's another thing that you don't have to worry about the projections. Like, oh, it's never happened. We don't really know. The traffic forecasters for this is called Steer. I don't know if Ryan's on the call. He actually knew the folks from his previous role, because they worked on the traffic projections for our bridges here in Louisville to Indiana. And so that was a newer thing, right? Like we didn't know what the bridge over the East End Bridge was going to be like. But in this case, we have over 10 years of data for this road. So that provides a little less risk for that too.
Yeah, and there are expected spurs, so there are enhancements being made to the toll road itself, additional access that they think is going to be unlock or add additional value. I think as Anthony pointed out, one of the unique things about this is obviously toll roads in the U.S. especially are scarce assets. There's huge barriers to entry. He mentioned, but I wanted to highlight. So SVP, so this is an existing asset in a fund. We have exposure, a small exposure to this. They're moving that asset into a CV, so a continuation vehicle. So essentially, we'll be realizing the realization when it's sold out of that fund, and we're looking to both maintain our exposure plus modestly increase the total exposure. And SVP itself, the GP, the entity is, as Anthony mentioned, not only rolling over their existing exposure, so kind of alignment of interest, but they're also increasing at their level the commitment to the new CV.
What's the purpose in rolling it over to a new vehicle?
It's for partially for alignment, like Steve said, but it's also because they think they're going to make money on it. So I mean, it's their capital, and they think that their projections are 3x net. Obviously we aren't underwriting to that. If it makes sense, that's wonderful. In a real asset space, if it just continually, provides, modest growth, with, that goes probably correlates with inflation because they'll be able to raise the rates on the toll road. that'd be great. But we don't have, if it does better, that's great. If we think it will still meet a pretty good return, just as a real asset, even if it doesn't have the extra value that SVP foresees and some of the other larger investors have put in there.
Anthony, correct me if I'm wrong here, but to maybe further that answer, typically a fund that I forget the date of this original fund, but these managers like to have assets, an exit that's profitable, because it boosts their returns or IRR or their X in that fund. This has been a profitable one from them. They can show a nice return in the fund and then replace it, but not have to actually get rid of the project. So as Anthony said, it's proven to be very profitable for them. So it'll, but it's time for that fund to take its gain.
That's exactly
Yeah.
right. I
Okay.
think that
So-
the term for this vehicle is set for 8 years. Actually, it could go longer depending, or shorter. But that is the term idea for this. So they could continue to, if they make the connector and other improvements to the road, and then realize some more value down the road.
Okay, so the connector will be the new road that has not been built and that has not been passed yet. And
Has
that's
not
where
been
the money's
passed.
gonna go?
That there, yes, I think some of that would happen for that. Yeah.
if it wasn't passed, where
there's a
would the
portion
money
that's
go?
unfunded. There's a portion that's unfunded as well. So,
And
it's
what
to
happens
buy
if
out.
it
This
doesn't
is
get
the money
passed?
is to buy out the existing interests of other people. So some people
Oh,
are going to be
okay.
selling. Yep. So there's $1 billion of that. Let me find the sources and uses for you.
And I think to Pruitt's point, and partially to answer the question, you're right. And we both talked to SVP and Wilshire talked to SVP about this as well. Typically, you'll see oftentimes an asset like this gets sold. It goes in a bake off, and they take bids for the asset, and the fund will sell it. What's a little unique in this circumstance is that SVP sees there's potential for additional value creation, which is really their bread and butter and what they look to do. So they see an opportunity here with this specific asset to create additional value that's going to both enhance returns as well as ultimately will pay off when they do go to sell it at the end of this CV's term in more favorable economics than what they're able to achieve currently.
Do you ever do a CV without looking for more investors? Or is this just a way to get more money to do more projects? And sorry if that's elementary question.
No, that's a good question. I mean, the secondary market, this has definitely become a bigger part of it. I think it's almost half and half now with regular. There used to be just mostly investors who wanted out and who wanted liquidity, they would sell. But now more and more the managers who have a really good asset that they want to continue to invest with will find a second. They take one of the secondary managers to lead the deal, and so and then they're able to buy out. So the proceeds are usually used to buy out the existing people. And then yes, the capital can also be used eventually. Some of it can be used for the additional investment if needed. But yeah,
Part of this goes
Okay.
back to what we talked about at the investment committee meeting. The amount of realizations, has really gone down. And that's caused for a lot of investors that denominator effect where they've committed capital expecting realizations to come in at a certain pace, and that pace hasn't been realized. And so now they have this imbalance between what they've committed on capital and the realizations that they're receiving. So there are some investors that are looking for cash flow options, which is a lot of times what CVs are, is an ability to pay out some existing investors in order for them to deploy to capital they've committed elsewhere, and without having to go through a sale process for the asset.
Got it. And we have 150 now and we're just looking to add 35.
So 150 is exposure across all of the systems to SVP. So to the funds that we're in. This asset within that exposure is pretty small. Anthony, do you know what exactly?
Yeah, I think it's around like 5 to 7 million. So it's a smaller piece. That's across everybody, not just K.
Oh, okay. Oh, gotcha. Okay. Thank you.
Just some quick questions on context for this particular project, and please just push back quickly if my questions are completely out of context here. But the USMCA is up for renewal next year, and obviously the I-35 corridor is a big piece of that. Depending on the administration, there could be additional tariffs that would perhaps reduce cross-border transport up I-35, and obviously disruptions at the borders or economic sanctions would impact Texas. So I'm just trying to think about a few economic factors that I'm sure others have thought about, but I'm interested in whether or not renewal of USMCA or any changes to it could jeopardize this activity on this corridor. I'm also interested if this is a standalone project in which risk and reward is entirely on the ownership, or are there any gasoline taxes in Texas that are pledged to some portion of supporting of this infrastructure? And then finally, just maybe it's a political question to some extent, but a toll road, even though it is a toll road, is still a public asset. And should we have any concerns about seeking to profit off of a public asset? Is there some guarantee on the lowest rate of return and some limit on the highest rate of return? Or again, is this sort of a wholly owned, they can set the tolls as they want? I guess I'm trying to figure out how do we protect ourselves from any kind of political consequences of the people who own this road looking at it and saying, we're losing traffic, we need to increase the tolls, and we're part of the cabal of investors that are reaping the benefits of someone charging for a public asset. I know that's a broad waterfront of things, but I guess those are just issues that I think about in this situation.
Sure. Yeah, no, it's definitely a political thing. I think they've done a good job getting folks who have experience with this, both at the the board level, management level, who've worked with Texas Department of Transportation and other similar agencies to manage that. They did pass quite a large increase last year. I think about 17%. I think that went into effect in November, and that has to be approved by Department of Transportation. So I don't think SUP can just unilaterally increase tolls. That has to be something that they work with the government for. And I think that they've had a history of of increasing it over the 7 years they've held this, and the traffic continues to grow. So I think that they may have some people who complain about things like that, but overall, I think that it was billed originally when Ferrovial built this as something that was going to be provided for the state that would not cost taxpayer money, and now that has been provided. And I think that they have the Texas Department of Transportation can do, I think, what's called it's something about convenience, self-convenience. They actually just did it to a road recently. That was the concession agreement was poorly written, or whoever bought it didn't pay attention to the documents. So they actually are going to be able to buy the asset for the Texas Department of Transportation, can take it back at below market price. That's not the case in this agreement, but you can look it up. It's called SH288. So this happened earlier this year. I think it's outside Houston. So that is maybe an extreme case that could happen. So the folks who bought in last year are going to not do so well, let's say, because it's contractually written that the department can acquire the asset back at the low. I think there's something written in there that they can buy it at a certain value, and that's not the case in this agreement. So they are able to take it over if they want to, but they would have to pay a market rate for this.
Yeah, and I think that one of the the differentiators here is this is not a new asset to SVP. This is an asset that they've been managing, and part of that management has been building the relationships with the Texas Department of Transportation, and kind of very working collaborative as to the expansion and the spurs that are anticipated here. And that's really, you'll see it's kind of a partnership. So from the raising tolls. So this is really, and as Anthony mentioned, they're all alternative routes. There always are alternative routes, right? And this is more of a convenience that's both commuters and businesses are willing to pay for the time savings of the convenience. And it's been, with the projections and with the actual historical data that they have, even in COVID, the downturn was less severe than anticipated. I mean, they've been able to build, it's almost, it's not quite that there's, the demand curve is inelastic, but it's proven to be relatively inelastic to the changes in tolls, given the cost savings and the convenience savings that commuters, both business and individuals, are realizing.
Did that address your issues there? We can't address the politics because we know nothing, but it is in the back of everybody's mind when you do this. Texas has had a much longer history or broader history of tolls. We in Kentucky, particularly here in Louisville, whined and complained about tolls on our bridges. The reality was all of the turnpikes in Kentucky were built and financed with tolls. Many of you are too young to remember the tolls, but we had them on every turnpike. So, but now we got out of that habit. Texas didn't. They've had toll roads for many years. Florida is another state that's used toll roads extensively. And once you get into them politically, it's less controversial, I guess. Once people become accustomed to them.
I was worked my way through college as a toll collector on the Kansas Turnpike.
Oh, okay.
Oh, wow.
And they just replaced all human toll collectors with automated tolling. So
Well,
I would, if I'd chosen to pursue that as a career, I'd be out of work right now.
You could move to West Virginia. I think they still have them in West Virginia.
Well, there you go. Yeah, you gotta have
they
your
do. Yeah.
you gotta have your $8.50 if you're going to get through West Virginia.
Are you planning to walk through like a little bit more of the presentation? Are we going to look at, okay, here's what we're expecting for, projected return and holding period, that kind of thing?
I'm happy to talk to it. We think if the full goes to term, they'll continue to just, yes, it'll grow. Their exit market, obviously there's not a lot of assets like this, but one did transact around Denver recently. And it was at a significantly higher multiple than what is happening here. And I think that the dynamics for that toll road are not as favorable in terms of growth as the Texas area. So it is still an attractive. We think these are attractive and unusual assets that don't have a lot of that you can't easily get exposure to. So I think that's what's interesting here. The growth projections are very high. We aren't really even paying that much attention to it. I think if it happens, that's great. I think just regular increases to the tolls and continued traffic growth would make a high single-digit return for us in our base case here.
And in the Wilshire analysis, the downside of what would be the poor utilization of these roads still gave us a return of 6-7%. So it's I think it's very skewed favorably to the higher returns, without those returns being in pie in the sky, because we know what the traffic is on it. There are obviously events that could change that a bit, but the downside looks pretty attractive.
Right. And it went through COVID as well. I mean, the traffic continued to grow. Obviously Texas, handled COVID a little different than maybe some other places, but yeah, I think they handled that, which is, you know, another unusual event. And so, yeah, I think it seems relatively well protected and something that fit well in the real return area, which is why we were interested.
And
And I
just,
think from a real return perspective, you know, as Anthony and Brett both mentioned, that the base case for us is kind of how we're pricing this out. And we think of the base case is high single digit net return over the investment period, with the potential for value creation and upside that, you know, that is pretty significant, especially for this asset class. So I think, you know, we're looking at it as if it just maintains base case, we're looking at, you know, net returns in the high single digits. And if some of that value creation is realized, which, you know, if we probabilistic weighted, and obviously SVP as the manager views this, and they're putting their money where they are too, they're investing their own money. They think that the upside of the value creation, both from a magnitude and a probability standpoint, is pretty high. So we're not viewing this with that upside. We're not thinking that that's where the return stream is going to be, or what the ultimate return is going to be. But we think that there's a good probability that there's going to be value creation here as well.
yeah, and the parent company, the Coastal Ventures, is I won't say unique, and that's a much maligned word, but they're not getting out of their areas of expertise. They are really do a lot of infrastructure deals, and I actually dealt with them on a couple of transactions back in my previous life, and they were very professional and very knowledgeable of the areas that they specialize in. So, you know, when you hear all the publicity about some of the Apollos and the like out there, Coastal is kind of on the other end of the scale in terms of how they operate.
One more question for me. Is the existing fee structure with the current investment changing at all?
That fund is already out of its investment period, so it's just charging on invested capital at this point. It's still higher. I think it's with us and Wilshire's aggregate, I think we're at 1.35, I think, but I can look at that and get back to you.
So that's the current
in the fund 4,
fee?
yeah, the fund 4 fees.
Okay, so then when it goes to the new one, what happens then?
The new one, it'll be at the 1%.
At the 1%. So the fees are going down?
Yes.
Got it.
Okay, these are all very good questions, and you know, and I think as you can tell, the staff is very positive on this, and so if there are no more questions, is anyone ready to make a motion to approve the continuation vehicle?
So moved.
Second?
I'll second.
Thank you. So we have a motion on the table, and I guess we'll do an actual roll call here just for the record to approve the investment as presented with the continuation vehicle of the SVP project. And so Sherry, will you do a roll call?
Yes, sir. Mr. Pruitt,
Yes.
Mr. Atkins,
Aye.
Ms. Bova,
Yes.
and Ms. Thompson.
Yes.
Thank you.
Well, thank you all for your interest in digging into this. You know, it's helpful, I think, and to dig in, and thank you for your time. And
Mr. Lane, before you go, I just wanted to say that the motion will be contingent upon successful contract negotiations as always. So I just wanted the board to be, you know, fully aware of that.
oh, we got the lawyer stuff.
I'm sorry. It's
Oh, we do. Yeah. We do have to do it. Vicky's helping us.
That I thank you for that. I should have put a parenthetically in there, but hopefully we'll being that this is not new money, it makes it hopefully a little simpler. And so thank you all very much again for your time, and we'll root for cooler temperatures and successful football weekends and high school, college, and whatever. And I will officially adjourn us, and I don't think we need a motion for that.
Thank you very much.
You do not.
Thanks, Kurt. Thank you, everybody.